And you're being so light.
Okay, folks. One very small note before we start. If you downloaded your case day before yesterday or something, there's one small typo. I'm sure you've all noticed it because you've all read it thoroughly. The case says the weighted average duration of the debt is 4.14 years, but there's an exhibit that backs it up from Bloomberg that says 4.41 years. I've resolved it now. They both match. But I'm sure you've been losing sleep over that mismatch. And if you have, you can go back to sleep again, but it's all okay. Yeah. So, but do read the case. It gives me a chance to nag you again. Read the case at least before you take off and get something done before you leave. Okay. So this is our last week before break, and I want to complete the discussion of the return part of the investment principle. Now, we talked about capital expenditures. Now, if you look at the page that I'm showing you in your slides, it reflects how old I am. Okay. I actually changed the example. I read it and said, who'd come up with something like that in today's day and age? Do you see what it is on your slide? There's a software company that does what? Mails out CDs. This is, and most of you don't even remember the time. There was a time when the late 90s, especially AOL, the way they got new customers is they sent out CDs in the middle of magazines. So basically, you bought a magazine in the newspaper stand, which you don't do anymore because you read it digitally. You shook the magazine, 3 CDs would fall out. And 2 of them would be AOL CDs. You'd put them into your computer, and AOL basically took over your life. You know, they'd give you a free subscription. So I'm going to change it to reflect the time and age we live in now. Let's take streaming, right? It's the mood of the moment. Entertainment clearly has been disrupted by it. Let's say you run a streaming company. You stream movies, you stream content. Your biggest value comes from having subscribers on your platform. Let's assume that it costs you $100 million to acquire new subscribers. When you acquire new subscribers, you offer them 3 months of free subscriptions, or you offer them half price for the first year. It costs you $100 million. And your accountant tells you that you can legitimately treat it as a capital expenditure because your subscribers stay on for a long time. But I want to make this about brass tacks. I want you to think about what will happen if you capitalize this expense as opposed to leaving it as an operating expense, first on your earnings and then on your cash flows. First, when you capitalize something, what does it do to your earnings? Increase it or decrease it? It'll increase it because you move something out of the operating. So when you report earnings per share, accounting earnings, you're going to report higher earnings. But from a cash flow perspective, what does it do for you? Would you rather? Yeah. It's going to give you a big, you're going to get the tax benefits up front. Remember, you get the same tax benefits over time, but you're going to get it all up front. And again, it's a no-brainer. If I gave you a choice, you're going to expense it. And this is at the heart of this R&D debate that, should R&D be capitalized? Absolutely. From a logical standpoint, it makes sense. But for technology firms, what the government allows with R&D right now is your best case scenario because you're allowed to expense it. In fact, that was one of the few things Congress did this year was actually the R&D provision because of the 2017 Tax Act was finally going to be required to be capitalized for tax purposes. They fixed it back again, so you can still expense it. From a tax benefit standpoint, you want to expense everything. So again, this is this debate, earnings versus cash flows. It plays out in choices made, and you can already see why there is so much pressure on companies to maintain not 2 sets of books, but 3 sets of books. One for reporting purposes, one for accounting purposes, and one for tax purposes. So next time you see the earnings per share and income for a company, you're getting the reporting income. Now, if you go to the Federal Reserve site in St. Louis, they actually have a database of the collective taxable income that companies report to the IRS because it is in the IRS database, it's public information, and what they report to shareholders as income. Take a look at that graph because it's going to give you that divergence that's happening between what you see as tax income and what you see as reported income. Which brings me to the last issue. So we've talked about depreciation, why we added back. We've talked about CapEx and why we subtracted out. Let's talk about the working capital effect. Many people look and say, what's the big deal? It's just working capital. The reason we worry about working capital is it creates what are called wasting assets. What's a wasting asset? It's something that doesn't make you money while you hold it. Classic example is inventory. Anybody who's had a family business that's retailing, that stores, knows that having an overfilled storeroom or inventory is not good news. It'll kill you as a company. You can actually, if you take a walk down Bleecker, and since I've taught you for 40 years, that is a street with the highest turnover in stores you will ever see. You can tell which stores will not make it by just going into the store. If the store is overfilled, I guarantee you, it's not going to make it. As a customer, you think, this is amazing. The store has a lot of stuff. The downside of having a lot of stuff, that's a lot of inventory, that ties up cash. And it creates a scenario where as a store, you could be looking good on an income basis, but you could be going bankrupt because of your cash flows. So when we look at working capital, the reason we're doing it is we're bringing in those wasting assets. Inventory, obviously a wasting asset. When you sell items on credit, is it a wasting asset? Complete the thought though. It's a wasting asset if you don't do what? If you don't collect is the first step. That's a minimum. If you don't charge interest, right? If you sell items on credit, and this is why department stores are so eager to, I mean, I haven't been in a department store probably in a decade. It depresses me to go in there. But when you do go in there, they try to sell you while you're paying for things. Would you like a Macy's credit card? No, I don't. We'll give it to you right now. There's no annual fee. We'll pay you to have the card. Because once you have a Macy's credit card, they want you to put it in the Macy's credit card. They can collect the 18% interest or the 3% off the transaction. If you charge interest, accounts receivable is not a problem. But if you sell items on credit and you don't charge interest, and God help you, if you don't collect, it gets even worse, then it's a wasting asset. So as you look at those working capital items on the balance sheet, I want you to think from this perspective. What is that item? Is it tying up cash? Is it a wasting asset? And if it is, I need to bring it into my cash flows. When I look at capital budgeting done by small businesses, what I notice as the biggest, there are lots of missing pieces. One of the missing pieces is they just ignore working capital. They don't think of it until too late. So they do CapEx, they do depreciation, and then working capital, they just ignore. And here's the worst part of it. The faster you grow, the more working capital is going to drain your cash flows. So the working capital effect essentially brings this. So we've gone from earnings to cash flows by adding back depreciation, subtracting CapEx, subtracting change in working capital. Let's talk about incremental cash flows. It sounds like a fancy word, but here's the test to run to see if something is incremental. Ask two questions. What will happen if I take this project? What will happen if I don't take this project? If the answer is the same for both questions, it is not an incremental item. I'll give you a couple of examples from this project. Remember I talked about the $500 million that Disney has already spent on this project? Let's put it to the test. What will happen if I take the project? Well, I've spent the $500 million already. What will happen if I don't take the project? I've spent the $500 million already. This project makes no difference. That $500 million should not affect my decision. So I'm going to take it out of my initial investment saying that money is gone no matter what. Rejecting this project is not going to bring it back. I'm going to ignore it. Yes. The longer you get in the project, more of your costs are going to get sunk costs. It's going to get more and more difficult to so that's the problem. And we'll talk about the anomaly that's created by this problem, because if you keep spending money before you come to me for a project analysis, I'm not going to get the money back. And I make the decision based on incremental cash flows. You could be killing the business over the long term because of your sequencing of when you do project analysis. So the $500 million, I'm going to add back. Everybody comfortable with that? So basically, I've already spent it. It's not going to come back. It should not affect my decision. It reduces my initial investment only to the $2 billion that I actually have to spend. There's another non-incremental item. Remember that G&A that I allocated to this project? And I allocated it. And accountants have good rationale for doing it. But I said 2/3 of that G&A is going to be there no matter what. So if I don't take this project, all I'm going to do is move it to a different part of the company. I'm not going to cut back those costs. It is a non-incremental expense. So the way I account for that is I say I should never have subtracted that out. And I added back with one small caveat. When I subtracted it out and gave me a tax benefit, I lose both. So I have to add back the net effect. So I'm adding back 2/3 of the G&A net of taxes. Now, I'll give you a very simple story to illustrate incremental versus non-incremental. Until about maybe 7 or 8 years ago, I used to do the investment banking training programs for the analysts, the undergraduates that they would hire. I did JP Morgan for like 31 years. So my August were filled with investment bank after investment bank after, I wouldn't even know which bank I was in on any given day. And by the time I got to the end of August, I would be so exhausted, I'd be on autopilot. This is a 3-day corporate finance class or 3-day. So I was doing, I think, a 2-day corporate finance class. I don't even remember the name of the bank. It was at a 5-star hotel uptown in a big ballroom. So there are 300 analysts. It was a good year for banking. I could always tell it was a good year for banking by looking at the size of the class. I remember the largest class I ever taught was in 1999, a Merrill Lynch class, where they had 450 analysts. Where are they all going? I mean, clearly this is a bubble. So it was my advanced bubble indicator. You know? So this was a year, 300 people. It was a pretty good year. And it was in a hotel ballroom. But the problem with ballrooms in hotels is they're not designed for classes. They're flat. Right? Basically, if you have a flat room, you can't see anybody. And I really didn't care whether I could see them or not. They didn't care whether they saw me or not. We were at that stage in the process. So I'm an autopilot, they're an autopilot. But there's one person in the room who was very intently listening to everything I was saying. It wasn't me. It was a guy who was setting up outside for the catering. Basically, it was a good year for banking. You could always tell by the quality of the food that they would serve during the training program. So the guy was setting up elaborate spreads outside of food. And he listened intently for the 2 days. So the end of the first day, I finished this section of the corporate finance class. He comes to me and says, I have a question. I said, go ahead. Nobody else seems to have a question. He says, I'm from Guatemala and I fly back once every year to visit my family. And when I fly back, I buy seconds from stores like the Gap or the Limit. You know what seconds are? Clothes with slightly damaged. They can't sell it. I buy them and then I take it back to Guatemala. I sell them. I make about $600. And it costs me $1,000 round trip to go to Guatemala. And all my accounting friends tell me that I should stop doing this. You see how the accounting mind works, right? $600 in profits, $1,000 in costs. It's a net loss. Stop doing it. So ask him the question, and you probably can guess what the question was. What's the question you need to ask him? Would you go back anyway? And he said, my entire family's there. Of course I would. And I said, don't have any accounting friends from this day on. Because if you listen to them and you stop doing what you're doing, guess what's going to happen? Next year, you're going to fly back. You're going to spend $1,000. You won't offset it with the $600. You're going to be worse off. You know how many decisions in business are made on accounting income? Accounting income reflects allocations, choices. You might be shutting a division down that you think is a money-losing division when in fact, incrementally, that division is creating profits for you. And those expenses find their way elsewhere. So when you think about incremental, ask yourself that question. What will happen if I don't take the project? Will this line, I go line item by line item, say, what will happen to this line item if I don't take the project? So in this case, those are the two. Now, incidentally, I could have come up with incremental cash flows much more directly instead of this because here I'm doing it indirectly, right? I'm doing an accounting earnings and then I'm correcting for my mistakes. I could have done the whole thing with just incremental G&A. And if I do it, I'll get exactly the same answer. You say, why didn't you do it in the first place? Because the accountants will actually give you the statement you originally saw with the allocation. So knowing how to fix what's been done wrong is a good strategy. But then checking to see that you did it right by doing it with just the incremental items is always a good idea. So in this case, the incremental cash flows reflect what this project is doing to Disney as a company in terms of cash flows. Now, incidentally, that 500 million that I added back is what falls under the rubric of sunk costs. Now, every finance textbook, the advice is clear. If you have a sunk cost, what should you do? Ignore it. You know how difficult that is to do for human beings? I'll give you an example. Let's say today, during the lunch break, you have an hour between classes, you decide to run an errand. Know what the errand is. You decide you have to go into a bank, actually physically into a bank. I've forgotten what the insides of banks actually look like, but there is presumably an inside to a bank. There's something you have to do. You think it'll take you only 5 minutes. You go in there and it turns out that somebody is sitting at the desk talking to the banker that you have to talk to. And you say, okay, I'll sit and wait. 20 minutes later, the person is still going on. What's a logical thing for you to do? Leave, right? I mean, you have only an hour left in the lunch break. Just leave. I mean, but you know what you tell yourself? If I do that, I've spent 20 minutes. If I leave, that 20 minutes is wasted. It's human nature. Sunk costs are easy to ignore in theory, very difficult to ignore in practice. I know you're not even reading the weekly puzzles, but my weekly puzzle from yesterday was about a New York Yankee named Alex Rodriguez. Okay. Alex Rodriguez got signed in 2005 to a 10-year contract, paying him $40 million a year. At that time, I mean, 2009, right after, 10-year contract. He was 29, 30 already by then. And by 2015, it was clear that, he was swinging at everything. He couldn't even see the ball, I think, at that point in time. He was a definite strikeout when he came up. And your reaction is, why do they keep playing him? And I said, look, who signed him on? A guy called Brian Cashman, general manager. Who's the general manager now? A guy called Brian Cashman. If you sit him down, what are you admitting to? That it was a mistake. So what do? You're going to continue to play him because accepting a sunk cost is also accepting a mistake. That sounds petty, but it's human nature again. A CEO will not admit to a mistake until it is way too late. So in theory, sunk costs are easy to ignore. In practice, very difficult. You're saying, what do we do about it? Here's I think the only way practically to do about it. When you have to make a decision, don't spend too much time on the backstory of how you got there. In fact, there's a very famous experiment called the Concord fallacy. And here's what the experiment involved. It involved two groups of people, and I think it was done at the universities. The two groups of students, each of whom was presented with a case study. In the case study, you have this aerospace company that's come up with a new jet, or and they've spent a lot of money to get there. They've spent $10 billion to get there, but they're very close to production. But it turns out that the competitors come up with a much better jet that is going to be, that's going to beat them. Essentially, they're not going to make money on it on an incremental basis. So the two groups, here's what the experiment involved. The first group, you go and present just the forward-looking numbers. You talk about the jet, the fact that the competitor has a much better jet, that you're not going to make money, and you ask them for a decision. Unanimously, everybody says, don't do it. Why would you do it? That's stupid. For the second group, the same case is presented, but with the backstory. If we've already spent 5 years and $10 billion to get to this point, and then you give them exactly the same facts as the first group, and the second group, it's not unanimously, most of the people say we should keep going. Why? We've already spent 10 billion. So it's easy in theory to do, very difficult in practice, but I think that's at the core of the sunk cost problem. But here's where ignoring sunk costs becomes an issue in the long term. Let's assume you have a project where you've essentially done $100 million doing the test marketing. Remember, test marketing is done first. You get to the project stage, you look at only the incremental cash flows, you come up with a net present value of 25 million. Now, if you follow finance theory, you say, look, I'm going to ignore the sunk costs. I'm going to take this project. The net present value is 25 million. Let's suppose every one of your projects as a company looks just like this one. You spend $100 million first, then you get to the net present value stage and you take the How long will your company survive? Not very long, right? Sounds like a strange example, but if you think about a pharmaceutical company spending R&D and then getting to a point and let's make a decision now, and you do this on every single pharmaceutical project. If it's not a cost plus business, we can pass R&D through, you're going to be in big trouble. To me, the biggest change in the pharmaceutical business in the last 40 years is when in the mid 80s, when I first started looking at pharmaceutical companies, had incredible pricing power. What did that mean? If they spent a lot of money on R&D or bad projects or good projects, they could just collect the costs and charge on new products, whatever that cost is, plus 15 or 20%. And what did they do? That effectively meant that they could give R&D a blank check, 5 billion, 10 billion, go spend the money. We're going to cover the costs anyway. And that's how pharmaceutical companies, the big pharmaceutical companies today, the Merck, the Pfizer, the Upjohn got built. And starting about 20 years ago, now, it's not just the ACA, the change in healthcare in the US, increasingly as insurance companies became the biggest buyers of drugs and you were negotiating with another big player, pricing power has decreased. Clearly, they still have pricing power, but it's not like it used to be. So and many of the companies continue to do what they did. Merck continued to give the R&D department billions of dollars, and they will ask questions later. And about a decade ago, they realized that asking questions later was too late. What does that mean? You effectively have to ask questions before you start R&D, even though your information is scanned. You say, is this the kind of drug where the payoff is going to be sufficient that we can take it? In other words, you are doing a prior NPV before you do that first dollar of investment with the limited information you have, because if you don't do that, you're going to end up in this scenario of having spent the money already, becoming a sunk cost. I'm going to make this personal because if you read the sunk cost puzzle, it actually had a postscript. How many of you are first year MBAs? Okay, most of you, right? And don't read this example if you want to depress yourself. I add up what you've already spent. I think NYU collects tuition before a semester starts, right? So you paid the first year's tuition already. So collectively, what are you, $100,000 in there? Let's say at this point in the program, you're looking at your future and you say, I don't think the banks are not coming the way I thought they would. Consulting firms don't look like they're showing up. And based on that assessment, you say, this doesn't make any economic sense anymore. Okay. I'm going to leave that thought right there because the question is, having spent a year and 100,000, you have an incredible sunk cost, right? It's and the 100,000 understates your true sunk cost. Why? You had a job, I assume, before you came for an MBA in which you had to pay. So basically, it's far more than 100,000, not to mention the personal cost of having to move a family or yourself here and the housing. I mean, basically, all the you have an incredible sunk cost. I can predict that next year, if you're in I will see you around school, almost all of you, even if you've changed your mind, because you're dug in too deep. Okay. So sunk costs basically are it's a behavioral problem. It's very difficult to look past them in practice, even though in theory, I'm going to be rational. You can't be rational with these costs. Unallocated costs, I told you what the basis is, right? Accountants go around allocating the costs because these costs have to go somewhere. And the problem again is for many large companies, these costs can be huge costs. So if I, as a large company, I allocate these big costs because as companies get bigger, they tend to get more and more G&A costs, bigger, headquarters buildings, the economies of scale don't seem to kick in very well on those costs. When you start allocating those costs and you start making decisions with earnings based on those allocated costs, you're turning away projects you should be taking. So one of the questions you always face when you look at a particular project, and you allocate G&A costs or any other allocated costs, is asking yourself how much of those costs are related to the project. How much is fixed and how much is variable? Now, looking at the line item itself might not tell you, but I'll give you an example, a way in which you might be able to get an answer of how much of the G&A costs in my company are fixed and how much are related to actually projects I take. Here I've taken a very simple example of a company where I have a history of G&A costs, 250, 270, 300 million. So I'm looking at the last 3 years and the revenues over those 3 years. So you know how much the revenues have changed. You know how much the G&A costs have changed. I made this example very simple for a reason. Is there a way you can tell me how much of the G&A cost is fixed and how much is variable based on that data? Manish? 250, and how do you come up with the 250?
220 actually. It's 220.
Tell me the process by which you're going through, because then we can.
Year over year, 30 million gets added, which is kind of looks like.
No, it's 20 million in year one, 30 million in year two, right? So it's not that that constant. Yeah. And how do you get the 10%? In other words, you have to bring the revenue change. The essence of a variable cost is it changes with revenues, right? So if the G&A, if it were all fixed, what should you see? 250 million all 3 years. So you take the change in revenue, 200 million, 20 million was the G&A. I made this example very simplistic. In the real company, the relationship is going to be. But if you took 20 years of G&A for Disney and 20 years for revenues, you can at least get a sense of how much of these costs are sticky. They have nothing to do with revenues and how much change with revenues. It's not a magic bullet, but at least you can get a sense of, how much should I be thinking about allocated G&A in this company. So if you get a chance, look at your company's history. I've Costco, I didn't give you that many years, but you can look at history to see what the G&A costs grow over time. So we've gone from earnings to cash flows, from cash flows to incremental cash flows. Any questions on incremental cash flows? Okay. Let's talk about time-weighted incremental cash flows. Just a fancy word for discounting and compounding, right? In finance textbooks until about 20 years ago, they've stopped doing this. Towards the end of the book, there'd be a bunch of present value tables The reason they've stopped doing it is you now have calculators, you don't have to do it. In a present value table, here's what you would see. The value of a dollar in 1 year, 2 years. So basically the table would be 1 through 20. The number of years would be on the left column. And how much a dollar would be worth in year 1, year 2, based on the discount rate. So if you have a discount rate of 0%, the value of the dollar is always the same. If your discount rate is 10%, a dollar today will be worth only 91 cents next year, 82 cents a year after. So basically, so it'll actually give you the time weighting. And the time weighting will be a function of both when you get the cash flows and how risky the cash flows are. It's actually a great intuitive way of thinking about this is what discounting does. So time weighting cash flows is just taking the present value. I don't know the last time you actually used a present value equation. Present value buttons on your calculator have dispensed with the need, right? I still don't trust. I'll be quite honest, it's just how old I am. I don't trust the present value of an annuity that Excel tells me is the present value of an annuity. I still insist on using equations, you know. But even if you never use this equation, at least be aware of what's happening the next time you hit a present value button on your calculator. If you have a single cash flow, all that's happening is that cash flow gets discounted back by whatever your discount rate is, 5 years, 10 years. So $1 million 10 years from now, what's the present value of million, a number of years, discount rate. When you use the payment button on your calculator, it's the present value of an annuity. That is actually the equation for the present value of an annuity. That's happening. If you don't trust me, check it out, right? In fact, I would suggest you check it out at least once. Go back to using the payment button if you need to. But that's the equation behind it. You can have a growing annuity. This is not in your calculator, but if you have a programmable calculator, build it in. It's a very useful equation. What's a growing annuity? Let's suppose I own a gold mine, which has 25 years of gold that I can extract. And I told you I'm going to make $1 million next year, and it's going to grow 3% a year for the next 25 years. There are two ways you can compute the present value. One is to take each cash flow, million, 1.03 million, and do that for the 25 years and discount each one back. It'll always give you the right answer, but it's a lot of work. The other is you could use this growing annuity formula to calculate the present value. And of course, you have two final present value equations that are mind-blowing in many ways because they go against every part of your fiber saying, this can't be right. The first is if you have a cash flow forever. It's called a perpetuity. There used to be bonds issued by I think the British and the Canadian governments had called console bonds. They might still, I'm sure they're still around. I don't know how many of them are left. A console bond essentially promises you a coupon every year forever. You can see why nobody issues them anymore. I guess in the 1700s or the 1800s, forever was still a viable concept. So if I promise you $5 every year forever, you have a perpetuity. The present value of a perpetuity is just that $5 divided by your discount rate. Simplest present value equation. And finally, you have an even more mind-blowing proposition, which is a perpetuity that grows at a rate each year forever. It's one of the most used and misused equations in finance. It's a growing perpetuity. To get the present value of a growing perpetuity, you take the expected cash flow next year. That's all the present value equation. It's got to be at the end of year one, divided by the difference between your discount rate and the growth rate. And the denominator is the source of models blowing up, right? Because if you're not careful and you let the G be whatever you want it to be, G is going to approach R and the whole thing's going to blow up. But if you follow the rules, it allows you to compute the present value of cash flows growing at a constant rate forever. Everything in finance, it's amazing how much of finance is this page. 80% of finance is present value, right? And these are all the equations you need. Now, if you bring time-weighted cash flows into a project and you look at decision rules that emerge, there are two ways you can bring in time-weighted cash flow decision rules. The first is to take every one of your cash flows, discount them back at your risk-adjusted discount rate. Is that too bright for you guys? I'll make it 75%. You're squinting. I think you should have drunk a little less last night, maybe. So the first is to take each cash flow, discount it back to today, add up the present values and come up with a net present value, including the initial investment. And the rule is very simple. If the net present value is positive, even if it's only $1, you should take the project. And that's mind-blowing to people. How much are you spending on this project? $5 billion? And I'm saying, even if the NPV is $1, you should take the project. Your reaction is, but I spent $5 billion, you're making only $1. What's wrong with what I just said? No, are you making just $1 when I say your net present value is $1? You're making what? It is $1 in excess of whatever your cost of capital is. That's why $1 is okay. It's you've earned your cost of capital plus $1, because if you don't take the project, what do? You keep it as cash, and the net present value of cash is $0. The net present value is positive, you take the project. But as I said, it's not intuitive. It's amazing how many CFOs can't deal with dollar values for projects, because when I ask you what return did you make on your portfolio last year, it's a personal question. Even if you want to make up an answer, you never give me an answer in dollar terms. You don't say I made $80,000 in my portfolio. You say I made 8%. We tend to think in percentage terms. There's a percentage version of a time-weighted cash flow return. Here's what you do. Rather than take the present value of all the cash flows and come up with a consolidated number today, you try different discount rates. You try 8%, you try 9%, you try 10%. What's your end game? You try to come up with that discount rate that makes your NPV 0. An internal rate of return is a time-weighted incremental cash flow return, as opposed to what? An accounting return on capital, which is based on earnings. It's not time-weighted. Think of the IRR as the modern finance analog to the accounting return on capital, which used to dominate in the mid-50s. Everybody used accounting returns. By itself, the IRR tells you nothing. So when I tell you this project's IRR is 11%, your reaction is that good? Is that bad? You still have to bring in your hurdle rate into the picture to compare to the IRR. The reason I bring that up is a lot of CFOs say they like to use IRRs. You know why they like to use internal rates of return? They said, I don't have to compute a cost of capital and all this beta stuff. I can completely ignore. That's not true. You still have to bring it in. You just bring it in later in the game. So let's try this for this project. And here I'm going to bring in a loose end. Yes, Gandhav. Beggars can't be choosers, right? I mean, let me explain. What do we say about the airline business? Terrible business to be in, right? Collectively, airlines have a tough time making their cost of capital. If you're an airline, you have a project with a net present value of $1, jump on it. Because right now, you know what you're taking? Project with net present values of minus $500 million, minus $1 billion. If you're Apple and I give you a project with a net present value of $1, the more opportunities. If you're NVIDIA, you definitely don't want to take a project with a net present value of $1 because you have so many opportunities where you can make 100 million. So if you have an opportunity set that is very extensive, clearly you want to go where you get the biggest NPV. But if your opportunity set has started to shrink, you have to go with what you can get. So I know $1 doesn't sound like much, but it's better than just running in place, which is what you end up doing. Yeah. And what is your net present value of investing in a risk-free security? And you get your risk-free rate. So when you earn exactly your risk-free rate, your net present value is 0, right? Yeah. It might seem like a lot of hassle, but you have a job, right? As a CEO, if you tell me that it's too much work to use resource to take net present values of $1, I'm going to put it into T-bills. And you keep doing this on project after project, I'm going to say, why am I paying you this salary and options? You're laying the foundation for essentially closing the business down. That might be the end game. But as if your choices are limited, $1 net present value is still good enough for me to take a project. So let's do the NPV and IRR for the project. Here I'm going to tie up a loose end I created when I talked about accounting returns on capital. Remember last session, I talked about the 10-year life that I put on this project. And I admitted that there was no real good reason. I just made up 10. If I'd made it 15 or 20, the project would have looked better. But my defense was, I can't keep computing year 11, year 12, year 13. It's just going to be, tedious and difficult to do. when I'm doing cash flows and I'm doing an NPV, there is an escape hatch. Here's what I'm going to do with the theme park. I'm going to get to year 10. And rather than shut things down, I'm going to assume the theme park keeps operating. And while it's operating, it'll continue to grow at the inflation rate. Your cash flows grow. What I'm effectively assuming is the number of people coming into the theme park levels off in year 10, but then I charge a higher price each year at the inflation rate. You know why I'm letting you grow just the inflation rate? You're saying, why don't you allow for real growth? And if I allow for real growth, I have to tie up loose ends. What's a loose end I'll have to tie up? If I say the theme park will grow at more than the inflation rate, more people are coming into the park's going to get more and more crowded. At some point in time, I have to expand the park. If I'm willing to do that, I can bring that in. But then in year 10, I've got to bring in additional investment to allow for the fact that I need more capacity. So here I'm going to assume that I'm full capacity in year 10. And beyond that, my cash flows will grow at 3%. And in this case, the inflation rate, which was 2% a year in perpetuity. You know what I'm setting up for, right? A growing perpetuity. And we said the present value of a growing perpetuity is the cash flow in year 11. That's why I'm multiplying the 715 million cash flow in year 10 by 2%, divided by the difference. And if that doesn't look familiar, that's my cost of capital for the project, 8.46%. Theme park project in Brazil minus a 2% gives me this immensely large number of 11.275 billion.
Is the 2%, so you said
Yeah.
the inflation rate, but when you're just saying you're going to expand after 10 years.
I'm not saying that. If I wanted to expand, I'd have set the growth rate above 2%, right? So by growing it just at the inflation rate, I'm saying, look, I've essentially hit capacity. I'm not going to go for more people coming in. But if I would set it at 3%, which would be above the inflation rate, I'd have come back and said, and I asked you, well, where is the additional capacity? What's the additional investment you will need to make to allow for that growth? So your assumptions about reinvestment have to be consistent with your assumptions about growth rate forever. That's all I'm requiring. I'm not saying one is better than the other. I'm saying whatever you're assuming, make sure you put closure on it. Right? So we'll talk about the intuitive reading of that, because this is something we do in valuation and capital budgeting. We come to the year 10 and we put in this big, gigantic cash flow. We call it a terminal value. As opposed to what? As opposed to a salvage value. A salvage value is when you shut the project down after year 10 and essentially sell off the pieces for what you can get. Lots of projects where you don't have the option of terminal value. The project just ends because after year 10, there's really no market for it. So this is, again, not a choice in terms of what you do. But if you have a choice, then you got to run the project consistent with that choice. So what have I done in this theme park that allows me to make this choice that I can keep going forever? There's something I did in the last session that's allowing me to do this. I put in a capital maintenance saying, because this isn't something, year 10 doesn't pop up on me unexpectedly, right? It comes right after year 9, and which comes right after year 8. So you can't just wake up on the last day of year 10 and say, you know what, I'm going to keep this project going forever. That's like eating, whatever you want till you're 65 and say, from this day on, I'm going to be fit. You're not in a position to make that judgment. In fact, it might be too late. So this is something you do from day one because that's where you're leading. Yeah.
I got my numbers here, but this 2%, is this the US inflation or is it the British?
Am I doing my analysis in US dollars?
I think so.
Yes, I am doing it in US dollars. That's why I use the US inflation rate. If I were doing this in reais, the inflation rate. So again, it's a consistent issue. Is one better than the other? Not really. I mean, as long as I'm consistent, So here's what my numbers look like on this theme park. And I remember showing this to a Disney group in 2000 something. Here are my expected cash flows for the next 10 years. And here's the terminal value. My net present value is 3.3 billion, positive. But what's making it positive? Which are the cash flows? It's my terminal value, right? Which should make you a little suspicious. Where did that gigantic number come from? And what does it mean? So I'm going to turn the question back on you. Intuitively, mathematically, you can show me what the terminal value is, but intuitively, what is the terminal value capturing in this analysis?
Is it like I'm not reinvesting in anything, using the current assets, I'm trying to make extra money or make money, make revenue.
No, but why is it so big? It still doesn't give me a sense of why is it so big. So I understand what you're saying, Justin. Again, it's the mechanics, right? But imagine you have an audience of creative people at Disney. They've never seen a present value equation in their lives. They don't even know what you're talking about in terms of present value equations. Yes. Yeah, that too. But if it was 70 years, the number is 11 billion instead of 11.2 billion. And we'll come back and talk about why the forever is okay here, because it's a long enough lifetime. You know what the terminal value is? It's what you would get if you sold this park, lock, stock, barrel, and Mickey included. You see why Mickey has to be included? If I try to sell this park at the end of year 10, and I said, I'm taking all the characters out of the park, nobody's paying me 11.3 billion. They'll pay me a lesser number. Is there a chance Disney will do it? Not really, but that's the hypothetical you're addressing. And it's true. That was the second question I was asked, was why are you assuming forever? So I actually did a sensitivity analysis. Remember that growing annuity equation? I can use it to do a 50-year life, a 60-year life. Once you get past 50 extra years, your value converges very quickly on the 11.2 billion. Something to remember next time somebody critiques you for the perpetual growth model. The perpetual growth model is not built on this idealistic view of the world lasting forever and your project going on. It's built on the presumption that if you have a long enough life for the project, this case with the theme park, I think I do, you can get away doing this because your present value is going to be pretty similar. So that's a terminal value, and the net present value is 3.3 billion. One of the things about net present value is it's not just a number about whether you should take the project. Net present values are additive. See, what the heck does that even mean? If I have a company which is worth 100 million that takes a project with a net present value of 5 million, that company is now worth 105 million. You can actually think of a company as the sum of the net present values of every project it's taken. So you can take Disney and say, net present value, the Avengers franchise, net present value, and you can add them all up and you should come up with the value of the company. So when I go out and take this project, my value increases by 3.3 billion. If this had been a project with $1, my net value would have increased by only $1. Question? Typically, it'll depend on the sector. In the entertainment business, do you think you can ever get away using a 50 or 100-year life? Probably not, right? You're pushing. In fact, if this were a Disney movie project, there's no way I'm letting you push the final year's cash flows into a perpetuity. So how long has Snow White been milked by Disney to make the money? With 1938 movies. So some movies, I guess, become classics. But in general, it depends on the business. In general, technology projects, I never use perpetual lives for the project. The company might. You see how you have to separate the company from the project. If a company is a collection of projects, even as projects die out, new projects, but an individual project in many businesses, you're lucky if you can get 5 years or 10 years out of the project because too many things are changing. In the case of in this example, I had a solid basis. I got lucky. I had Disney World, Disneyland, Euro Disney, Tokyo Disney. I could see that these projects are not just aging, they're aging well. They're continuing to generate cash flows. But I think it's got to be very company and sector specific in terms of answering, how long does a typical project last? So the net present value adds on to you. So if you take a project with net present value of 0, what happens to your value as a company? Absolutely nothing. What happens if you take a net present project with a net present value of minus 5 billion? It'll go down. But you're saying, who'd be stupid enough to do it? Every year there are a few hundred cases of companies that take projects with NPVs of minus 5 billion, I've seen project minus 50 billion. What am I talking about? What kind of project can destroy that much value in a moment? Is somebody back there? No? It has to be what? A big deal, a really, really big deal. What kind of deal is that big? in acquisition. More value has been destroyed. And I hate to say this because some of you will end up in this space. More value has been destroyed by M&A than any other single action I've ever seen corporations take. You can wipe out 20 years of work with one big bad deal. This didn't kill Microsoft, thank God, but the day they announced they're going to buy Activision, guess what happened to Activision stock price? It soared. But on that day, Microsoft lost $22 billion in market cap. You're saying that short-term or long-term, market's assessment of that deal was, this is not a good deal for you guys. And I still remain, I still believe that's true, that, you know, you go back in hindsight, the OpenAI deal is probably a positive net present value deal and could be a huge positive net present value. That Activision deal, I think, is and when Disney bought the portion of Fox that they got, 5 years ago, 73 billion, that was definitely a negative net present value deal. And that's just not the benefit of hindsight. At the time that you did it, I said, this makes no sense. Why are you paying $73 billion so you can control Hulu? And not even entirely. It's a deal that made no sense. Every time you overpay on a deal, that's like a negative net present value project. So let's talk about the IRR. Again, I know how you compute IRR. Use the IRR button on your calculator or the IRR function in Excel. And again, I don't trust those. And there's good reasons to be suspicious of IRR calculations. We'll talk about why in a session or two. But here, to compute the IRR for the project, here's what I did. I took the cash flows and I tried different discount rates. Remember, the definition of IRR is that discount rate that makes your net present value zero, right? This is called a net present value profile, and it captures what will happen to your net present value as your discount rate changes. Here's why I like net present value profiles to compute IRR as opposed to just getting an IRR number. First, the IRR is right there. It's the point at which you cross the x-axis. The IRR for this project is 12.6%. What do I compare that to? The cost of capital, 8.46%, good project. But here's what you get as a bonus when you do the net present value profile. See the slope of this line? What is that telling me? Think high school calculus, right? Is giving the delta in my net present value for every delta in my discount rate. Or we put economic intuition, it tells me how sensitive my project is to changes in my discount rate. Now, when you computed that when I computed that 8.46% cost of capital, there were a heap of assumptions I built in, right? Risk premiums, country risk, beta. Could I have been wrong on any? Absolutely. So when you do an analysis, you say, what if I was wrong about the discount rate? Or what if, even if I'm right about the discount rate, the T-bond rate jumps 3%? In fixed income, do you look at duration in your class? You did. No, even if you did not, do you remember what duration of a bond? The duration of a bond measures? Can be measured, it measures two things. What are the two things that the duration of a bond measures?
Average.
It's a weighted average of when you get your cash flows, right? That's one definition. What's the other? Nope. It measures how sensitive your bond price is to changes in the interest rate. High duration bonds are more sensitive to changes in interest rate. Does that sound a little familiar? What is this measure? This net present? It measures how sensitive. It's like a duration for a project with the cost of capital replacing your interest rate. So the way to think about this is, earlier we talked about two projects. Let's say they have, in this case, you're looking at one project, but let's say you have two projects and you're trying to pick between them. They have about the same NPV, 3.3 billion. But one, the net present value profile is steeper than the other one. You could argue that as a secondary level of risk, you're going to take the flatter net present value profile, saying it's less sensitive, it has a lower duration, it's less sensitive to changes in my cost of capital. So if you can compute the IRR, you're essentially getting a measure of, is this project a good project when you compare to the cost of capital? In this case, the NPV is greater than zero, the IRR is greater than the cost of capital 95% of the time for standalone projects. When your net present value says go, the IRR is also going to say go. We'll talk about the 5% where they can give you divergent answers, but for standalone projects, you get the same answer. Yeah.
So similar to start.
Yeah.
When you were connecting sunk costs to us being an MBA, sometimes blame that previous chart, is that more, is there anything you can connect that to? Is that more just strictly a corporate finance?
It depends on the business. Some businesses, changes in the discount rates have much bigger effects on your net present value. Why? Because you can't pass things through. So when you remember in 2022, when the risk-free rate popped, every company's cost of capital went up. Exactly. If you have pricing power, you might be able to compensate. Why? Because you raise prices, you come up with a higher return. But if you don't have pricing power, you're going to get squeezed. The macro consequence here is not all businesses are equally exposed to changes in cost of capital. Some are more exposed, they have higher duration. They're at more danger when rates go up, and they benefit more when rates go down. So you could actually take the entire economy, break it down by duration, or, duration measured as this, and say, these are the business I'd worry about the most if I think rates are going to go up, because they're going to be most impacted by higher rates.
Companies in completely different sectors could see this and respond very differently.
And the response is going to be determined by how much the external world gives them the power to respond, right? Because pricing power is something you don't, it's something that comes from the outside. Because you dominate a business, people are willing to pay higher prices. So in some businesses, you might be the best management. Management alone can't change this. It's the kind of business you're in.
Where they stand in the industry, or maybe an Apple.
Or the type of industry they're in, right? If you're a grocery store, you might have less power to pass through things because, you're kind of squeezed. People are, have tight budgets. They can't pay 30% more, So it really depends on both the type of, it could also depend on your business model. I remember in the late 90s, British Airways, these were good times, started making more and more of their flights from New York to London into business class. Why? Because you made a lot more money. At one point, I think in 99, half of the seats were business class seats. Amazing in the good times, right? Terrible in the bad times. So the IRR basically says, take the project. Yeah. You pay too much. Or there are no synergies. You just made up the stuff. You made the decision to buy. I mean, if you're asking why do acquisitions get screwed up so much, the answer is not in the numbers. It's coming from the process itself leading to bad decisions, right? So think about the M&A process. What is it that leads to bad decisions? First, who makes the decision to go out and buy a target company? Somebody at the bottom, middle managers, or somebody at the very top? Usually the very tops. So the CEO wakes up from a dream one day and said, today I want to buy a big company. So he tells his underlings, we want to buy that XYZ company. The underlings know that this will make the CEO happy. So they go and do the analysis and they bring the bankers in. Once the bankers come in, all is lost, right? Because what do the bankers want to do? Make sure the deal gets done. The process is screwed up. The process is screwed up because it takes overconfident CEOs and the decision they make and then fills in the rest with people who make money off the deal. So when we look at answers here, it's not in the spreadsheets. And you say, maybe why don't they get the synergy numbers right? It's about the process, because you don't fix the process. The end game is going to be the same. Okay. Depressing thought if you're working in M&A, but you have a job to do. I understand. Find a way to live with it, right? I mean, look, if I do, I mean, I would give you the same reaction that some, if you dropped if you saw $100 bill on the floor that somebody has dropped or sticking out of their pocket, you're walking behind somebody in Penn Station and you pick the $100 out of their pocket and I catch you. And your reaction is, if I didn't do it, somebody else would do it anyway. And sometimes that's what the deal making becomes, right? We know we're advising the company to pay too much, but if we told them the truth, they just go to a different banker and get the same outcome. As I said, you got to find, in the M&A process, some way to create either a differential edge or accept the fact that deal making is your business. It's the company's fault if they decide no. Now, let's get back to the question that Manish raised. I was doing everything in US dollars, and I told you up front, I was cheating. Because this is a Brazilian project, a project in Brazil. The cash flows are going to be in Rio. And I could have done my entire analysis in Brazilian real. So I'm going to ask you a generic question about currencies. And then we'll see if we can back it up. Do you think, I mean, with based on dollars, the project looked like a good project, right? If I'd done everything in Brazilian reais, would my answer be different? Then we're in big trouble. You see why we're in big trouble? Because switching currencies is going to make good projects into bad projects and bad projects into good projects. I mean, that's like, saying, today it's cold in New York because in Celsius it's 10 degrees and 10 is lower than 59. It's not, right? It's, it just feels like, so 10 is not lower than 59, is it? No, it is lower than 59. It's 50 degrees, yeah. But basically, switching projects should not change in net present value because it's just a measurement indicator. And it will not if you do things right. What does doing things right mean? If I have to follow a consistency principle, if I decide to do everything in reais, my cash flows will have to be in reais and so will my discount rate. So let's start with the bad news here. When I go from a dollar cost of capital to a real cost of capital, what's going to happen to my discount rate? Will it go up, go down, do nothing? It's going to go up, and why? But why? What makes it higher? Inflation. So it'll go up because of the inflation. My discount rate will be higher. When I do my cash flows for this project, and I do them everything in reais, that same inflation is going to play out in my cash flows as higher real cash flows. And I get to my terminal value, what's the inflation rate I'm going to end up using as in my perpetuity? Will be the real inflation rate. You might not believe this, but if you do things right, you will get exactly the same answer. And I will show that, at least with this project, in numerical terms. So first thing I'm going to do is I'm going to convert my dollar cost of capital, which is 8.46% into a real cost of capital. You've seen this conversion before. Take the inflation difference. My real cost of capital is 15.91%. Bad news delivered, higher discount rate. Remember, my cash flows were all in dollars. How do I convert them into real cash flows? What would I need? I need an exchange rate, right? And if I stay in the intrinsic value world and I have one currency's inflation being 9%, the other currency's inflation being 2%, is there a way I can get expected inflation rates? I'm sorry, expected exchange rates based on inflation? Have you heard of purchasing power parity? It's one of the first things you're taught in foreign exchange. Purchasing power parity, here's what happens. The expected exchange rate each year is going to reflect the difference in inflation. The higher inflation currency is going to depreciate roughly 7% a year in this case, because the inflation is, it's not magic. It's just, in fact, the economists used to have an index called the Big Mac index. I don't know whether they still report it. They actually would report the cost of a Big Mac in different parts of the world to show you whether purchasing power parity actually kicked in. This is just inflation playing out. So here's what I've done. I've taken my cash flows in dollars, converted them to reais using an you can't use today's exchange rate. That'll kill your valuation. That'll create inconsistency. I'm building in the expected exchange rate. I get my cash flows in reais, which I discount back at the real cost of capital, and I end up with a real net present value of 7.75 billion reais. Converted at the exchange rate that day, I get exactly the same net present value to the nth decimal point, but think of why I got it. I got it because I built in the same inflation effects into my cash flows and discount rates, which indirectly answers Manisha's question. Why do people, when they switch currencies, end up with different net present values? It's always because of inconsistencies in how they're thinking through inflation. I'll give you one classic example. I've often seen people do analyses in real using today's exchange rate. If you do that, what's going to happen to the net present value of this project? It'll go up immensely. It'll become 20 billion reais. Why? Because you've built in a 6% inflation rate. I'm sorry, it'll go down. No, it won't go up because remember, I'm using an exchange rate that's constant. My real cash flows are going to be higher, right? I'm sorry, real cash flows are going to be lower. Let me think that through. Okay. Okay, you're right, because I'm building in a 2% inflation rate into my cash flows and a 9% inflation rate into my discount rate. There's the inconsistency. Every time you get a divergence when you switch currencies is because we're messing up inflation one place or the other. Question? That will change, right? So, but they'll change both. See, that's why it's good to do this, because if I say, what if inflation in Brazil goes down to 6%? Is that good news or bad news for the project? My discount rate will be lower, but so will my cash flow. So basically, everything will adjust to changing those numbers. So this project looks like a good project, right? But let's be honest, I made a lot of assumptions to get to that net present value. Not just about the discount rate, but about the number of people coming into the park, the costs. And could I be wrong? I can start listing out every assumption. And I am going to be wrong on every single one of them. I could be wrong about the tax rate. I could be wrong about inflation. I could be wrong about essentially every input. So there is that NPV is a point estimate. You know what I mean by point estimates? I made assumptions. I came up with the number, but I could be terribly wrong. So let's suppose you're the decision maker, and you are. I come up to the net present value, and you're one of those people who's torn by internal angst about worry. You worry about everything. You sit there and you start worrying. I could be wrong about this. I could be wrong about that. Let me give you a few potential things you can do, and you tell me which way you can go. One is you could say, look, let's wait for the uncertainty to go away, and then we'll take the project. How long will you be waiting? Forever, right? That's not an option. The second is, you say, look, I'm not going to take the investment. What might lead you to do that, even though the NPV is positive? You don't care. You care about your job as a decision maker, right? You know what decision makers will do if I punish them, if they make mistakes and I don't reward them for the upside? They will not take risk. There's a reason government companies and bureaucrats are difficult to move, because there's always downside risk, but you don't get the upside. And if I give you bonuses based purely on the upside, you're going to be taking bad investments. But in this case, no, you will not take the investment if I keep punishing you every time you're wrong. And you're going to be wrong, not because you made you screwed up, but because the world changes around you. But it's not good for a company. You want people to take investments that are risky. You can always do what many companies do. Call in McKinsey. Ask them, should I take this project? As if they have some magic crystal ball. But here's why you do it. And here's why consulting makes most of its revenues. People don't want to be held accountable. You call in or if you have a boss, go in and pay homage to the boss. You're such a wise person. You know how to make the decision, pass the buck, right? In other words, you outsource the decision. Or maybe you're one of those people who can just completely ignore uncertainty. What kind of person would you be? Probably some kind of a sociopath. Psychopaths and sociopaths are very good traders because they're completely immune to all the behavioral things that trouble the rest of us. I'm assuming none of you are psychopaths. I don't want to think of you one of you. So clearly, none of those options is a healthy option. You got to deal with that feeling in the pit of your stomach. And I'll give you 3 ways in which you might be able to make that uncertainty, if not go away, manage it. One is, what's the big thing about this project that's worrying you? That money you spent up front, right? That $5 billion. One of the oldest risk measures or metrics that people have used to make them comfortable is called payback. What is payback? You look at how many years it will take you to make your money back. It's a very simplistic measure. So all you do is you add up the cash flows, and in 10.3 years, you make the $5 billion back. If you want to do discounted cash flows, it'll take you 17 years. You say, what do I do with that? There are companies out there that have payback restrictions, that they will not take projects that take more than 3 or 5 or 10 years to pay back. Earlier, we talked about how different businesses, you have more instability, more disruption. If you're in a business where there's a lot of disruption and things can change, you might say, I'll set a payback restriction. Simplistic, not very sophisticated, but it kind of gets the job done. The second is to ask what-if questions. And it's become so easy to ask what if questions. Right? You do an Excel spreadsheet. What if this? What if that? I think it's become way too easy. Sounds like a strange thing to say. But I'll give you an example from the summer of 1980. Summer of 1980, I was in the middle of my MBA program, thinking deeply about sunk costs. Partly because we're in the midst of one of the worst recessions since the Great Depression. 1980, Paul Volcker had become, and there were no jobs to be had. So I was desperate because I needed the money. So I took a job at a company called Watermark. It's not even a company, it's a small business. Its business was producing a radio show, a syndicated radio show called American Top 40. The show's still around. If you drive around the US anytime, anywhere on a Sunday and you turn on. But at that time, they had the show, and the DJ for the show, have any of you listened to American Top 40? It's an incredibly creative concept. Here's what it does. It starts with the 40th most listened to song and then goes 39, 38, 37, 36. It takes about 4 hours because in the middle, the DJ has this pattern and he talks about the artist and he talks about the song. So Casey Kasem was the artist, 4-hour American Top 40, which they syndicated to radio stations around the country to play. You know how syndication works? Effectively, these stations would pay, I think Watermark got $1,000 from each station. There were 520 stations that paid American Top 40. So they made about $520,000 every week. Good business, but single show. And they were hiring an intern from UCLA. And I happened to not have a job. And they said, "I'd like you to come in and intern." I said, "What would I be doing?" They said, "You'd be looking at a new show that we're thinking about producing called Soundtrack of the 60s. Another incredibly creative concept, because here's what they were going to do. This is 1980. They were going to go back to 1960, same week. And guess what they were going to do in that week? Look at the top 40 songs from that week and play down the top 40. And they had found a DJ called Murray the K, well-known radio disc. And my job was to do the capital budgeting. So I show up on my first day expecting, that somebody would give me the cash flows and the discount rate. So I walk into this small business. The CFO had a cubicle. He didn't even have an office. A cubicle. And I said, "Where are my cash flows?" He said, "What cash flows? That's your job." So what's a discount rate? I have no idea. So I sit there with a blank ledger sheet. And I start thinking about how am I going to come up with cash flows? So how did I say American Top 40 worked? You got stations that bought your show. They paid $1,000. So I said, I need to know how many stations will buy this. I have no idea how this works. So I went to the CFO and said, how do I get the number of stations which will syndicate the show? And he said, go ask the marketing guy. So I go in his cubicle. He hated me from the day I walked in. He was a creative guy and he didn't like numbers people in general, I think. So he acted like I wasn't even there. So after about 3 days of standing outside his cubicle, waiting to be seen, I finally said, "Look, I've got to get started. How many stations do you think will buy the show?" He said, "I don't know, 200, 300, 400, something like that." And I knew that this was all I was going to get from him. So I start my ledger sheet. Top line item, number of stations which will buy the show. Guess what I used as my base number? I used 300. He said 200, 300. I'll go with the middle number. And I built the rest of the spreadsheet like this with little pieces of information that people threw. And about 6 weeks later, I had cash flows and I was actually pretty proud of myself. I came up with a net present value that was negative. I went to the CFO and said, look, I'm ready to present. He said, come back tomorrow. We'll all get together, the CEO, CFO, 2 board directors sitting around a coffee table with cheap coffee. And I presented. And I say, no, climactic moments. The net present value is negative. You shouldn't take the show. They look at each other and say, what would happen if you tried 400 stations? My stomach drops. I say, what's the big deal? This is a ledger. I've filled in every single number that's based on 300. Changing 300 to 400, you know what I'd have to do? Go in and redo the whole thing by hand. There's a reason people didn't ask what if questions in 1980. Today, you've done a spreadsheet. You put in 300 as your base number. You change it to 400. Not a big deal, right? It takes like 20 seconds. So what happens? You ask what if questions about everything under the sun. And you forget why you're asking what if questions. You think the what if questions are the end game. This case that you're doing, there's been a variant of that case every year for the last 40 years. I've basically made up crap every year, and this is your case. And I'm going to beg you with the same plea that I begged this is not, I'm not expecting creative novels. I want this to be short, basically 2 or 3 pages of whatever your thoughts are that might be, not numeric. And then the rest is all the numbers. And most people listen, but I remember about 10 years ago, people, I didn't remember what the case was. At the end, they come in and turn, and there's one report that sits out, it's like 110 pages. Everything is like 10 pages. Pick it up and I say, what have they done? They ran 103 scenarios on the print. And here's what they ended up with. 53 of the scenarios, the net present value is positive. 50 of the scenarios, the net present value is negative. So I get to the final page, and here's what they conclude. They said, if you believe you're going to be in a positive net present value scenario, take the project. If you think you're going to be in a negative net present value scenario, don't take the project. We're too confused, you make the decision. At least they were honest, because that's where a lot of what if analysis leads you. Is it, you think you're going to converge on a decision after you run 50 what ifs, you actually end up more confused. So keep your focus when you do what ifs. Less is more. Don't ask questions about every input. Pick 1 or 2 inputs that you think are key. So the Costco clinic, if you want to do what if, pick the assumptions that you think make the big difference, focus on them. And when you're presenting results, don't present 10 more tables. I can promise you, I'm not looking at the other 9. Because when you mow people down with hundreds of numbers and spreadsheets, nobody's reading them. Show it as a picture, not the Excel graph type, because Excel graph, it's always insert chart, everything becomes a picture. But often you're telling a picture that tells me nothing more than the numbers. Find a creative way to do this. And I'll show you my favorite picture of all time. Okay? I don't know whether you've ever read this guy called Edward Tufte, Tufte. Amazing books. Now, I don't know, he teaches an Ivy League school. I don't know which one he teaches at. But one of my favorite books called The Visual Display of Information. It's about how to present information. In fact, have you ever heard of Tableau? Tableau was founded pretty much on that thesis of, hey, there have to be better ways of presenting things. And this is my favorite graph of all time from that book. It's a story of Napoleon's ill-fated expedition to invade Russia in the early 1800s. The early 1800s, Napoleon wakes up one day in Paris and he says, I'm going to invade Russia, just like a CEO says, I'm going to acquire a company. And he gathers this huge army. They're leaving Russia. So the width of this line tells you the size of the French army as they leave Paris. So Napoleon's on a horse, everybody else is walking. And they walk. You say, what are these little tangents? That's when they get distracted and they invade Poland along the way, because Poland always is in the way, and you basically get. And they march across. He's saying, why is the width of that graph decreasing? Because it's getting a little colder. It takes a long time to march from Paris to Moscow. So as they get to Moscow, the army shrunk by about 2/3. They get to the outskirts of Moscow, and the gate at which Napoleon stops is a big thing. If you go to Moscow, they show you the gate and they say, we fought off Napoleon. Actually, they didn't. Winter fought off Napoleon, because by the time he got there, people were cold, they were miserable. And Napoleon said, this is not worth it. What was I thinking? And they walk back. By the time they get back to Paris, there are 3 people carrying Napoleon, I think, the whole. This is a great chart, because in the chart, it's also the temperature. Remember, this was hand-drawn. So you see the temperature dropping and you see the army shrinking. All you have to tell me is what will happen to Costco clinics if the EBITDA margin is not 25%, right? Your task is far simpler. But I think finding creative ways of presenting what-if analyses is one way to deal with the uncertainty of field. Which brings me to the third way. And this is something I could not have done 30 years ago without access to a mainframe. Remember I described my 3.3 billion as a point estimate? It's a point estimate because my assumptions were point assumptions. The operating expenses are 60% point estimate. And if I pushed you on each assumption, my guess is you're probably saying, that's sure. You know, it could be 60, it could be 70, it could be 50. What if I let you take your 3 or 4 biggest assumptions and present them as distributions? What's a distribution? You tell me your expected value, you tell me what you think the range is, you tell me what the distribution is. It's called a Monte Carlo simulation, where instead of point estimates, you have distributions. In this case, distributions for revenues, because I'm not sure whether I'll get the revenues I thought. Maybe I'll do much better in Latin America than I thought, or much worse. So I put distributions. My expected value is still the same as my point estimate. I put in distribution. In a simulation, here's what I do. I go pick one outcome out of each distribution. So that outcome can be better or worse than my point estimate. I come up with the net present value, and I do this over and over again. I use this add-on called Crystal Ball, which all of you have access to. And I'm not, you don't think of this as a suggestion. You have to do it on Costco because there's a reason why it needs more work than just taking numbers and putting in some arbitrary distribution. But I'm saying it's a good tool to have with any spreadsheet because it can take expected values, and what you get as output is a distribution of net present values. So this is my theme park with a distribution of NPVs. And I'll give you the non-surprising news. My median NPV across all of my simulations, I think I ran 10,000. Crystal Ball's default is 10,000, was about 3.3 billion. Sound familiar? The result is my base case. Shouldn't be surprising because I built off the same. So you're saying, why did I waste my time doing this? Because remember, in many projects, you'd see people doing best case and worst case. One of the worst, most useless things you can think of in a project, because I'll save you the trouble. The best case, the project is worth a lot. In the worst case, it's a terrible project. It's in there, right? Best case, worst case. But you can break it down, 10th percentile, 20th percentile. You can also estimate what percentage of the time the net present value turns negative. Because remember, that's your worry, right? There's 11%, there's a 12% chance your NPV will be negative. Again, I'm not suggesting you change your decision based on that, but that can now become part of your decision process. Here's my NPV, here's the chance I'll be negative, because you don't want to be rejecting projects if there's a small chance of it being negative, because you're effectively double counting risk when you do that, right? You built in a risk-adjusted discount rate. But what you're looking for is some kind of comfort. I do this in my valuations all the time. When I value a company, I get a distribution of values because I know my value is going to be wrong. And this gives me a sense of, hey, what is my margin of safety built into the project analysis itself? So we will talk a little bit more about this kind of analyses when you come back from your spring break. So you have everything you need to do the project right now. We talked about the cash flows and discount rates. So if any of you are going to be stuck by yourself while you feel sorry for being left by yourself for a week, make it your opportunity to kind of get most of the project done. So I'll see you after the spring break. One other thing, I will not send you emails for a week. I'll have to figure out when I start. It'll tear me apart, but no, you will not hear from me for a week. But then you will hear towards the start of class next week.
So in my project, I took PepsiCo.
Yeah.
So they have their divisions of their business segments are region wise.